You may have heard of M&Ws before, and well, if you really wanted to, you can see an M&W everywhere and anywhere on the chart. It's not about identifying this pattern alone for entries, it's about identifying them in the right place in the model. If you don't know what I mean, see my video where I explained the model we trade. I'll link it up here. Or consider joining TTC to learn how to trade like this in detail with ongoing guidance from our team by using the link below. By the end of this video, you'll understand how to spot M's and W's, two patterns that could be the key to unlocking your success in crypto trading. If you're new to crypto and you want to learn everything you need to know in one place, be sure to hit the like and subscribe below so you can be notified every time I drop a new video. So if you're ready to learn how to spot the perfect M and W patterns, let's dive right in and break it all down. The most powerful setup in the weekly setup, the 3-day swing, is the multi-session M&W. But what is an M&W? An M is simply a high followed by a lower high, and a W is simply a low followed by a higher low. The concept is simple, but if you were to take what I just said and apply it to a chart, you're going to find M's and W's everywhere. So let's start with the perfect M. Just a quick reminder, where you see Asia, UK and US, this represents a session. All three of those combined with a shaded background is a trading day. So Monday, Tuesday, Wednesday, Thursday, Friday, then the weekend. The perfect M consists of the market maker creating the first peak of the M in one session and the second peak repeating the level but falling short either in another session or another day, giving you a multi-session M. We want to be looking for an M formation, ideally after 3 level rises. For the first side of the M formation, we want to see the market makers show up with bearish candles, or what we like to call a stopping volume candle. Think of a stopping volume candle as someone slamming on the brakes to slow the momentum to the upside. This candle will usually present as a smaller bodied candle with a very large wick to the upside, and the volume will be quite considerably high compared to anything else around it, other than the previous large vectors that created the rises. We can see that volume here in the PVSRA. Here is actually a perfect stopping volume candle, so small body, large wick to the downside, and the volume in that is very high. So that's what we would like to see if we were looking for a W formation. That is a stopping volume candle. Once you've identified your stopping volume candle, you just want to go ahead and mark that out. Let's talk more about what's happening in this circled zone here. You have to understand that there are traders out there who don't wait for candle closes. So whilst this candle is open, it's going to look like a big green candle that's never going to end. And that's when those traders just jump into a trade. Keep in mind that in order for retail to buy, someone has to sell to them. Cue the market maker. Then the candle ends up reversing, and that's what creates the wick to the upside. But at the same time here, we have a bearish railroad track, which is a bearish candlestick pattern. So once that bearish railroad track closes, or a bearish engulfing some may say, it traps anyone who went long at the worst possible time. Whether they have their stop loss down there, it doesn't really matter, but those who are on high leverage 100x will more than likely get taken out if price was to retrace just the smallest bit. Once they enter a position, their stop loss or liquidation level provides liquidity in the opposite direction. The market maker knows, for the most part, that majority of retail traders, when a trade is going against them, instead of taking the loss, they will hold through it, cross their fingers, and hope that they can get back out at break even. This is what is happening in the initial peak of the M, and that is the market maker hitting the level. So the first part of the M formation, we want to find our stopping volume candle after 3 level rises, ideally near a key level being the high of the day, high of the week, or a high liquidity area. Once we get the first peak of the M or W, price should pull away pretty quickly. This keeps those who went long at the worst possible time trapped, and also creates the inside left side of the M. There's not really anything that goes on here, but on the inside right side of the M formation is the second time that the market maker will show up. And this is because they are trying to encourage retail to take a one last chance wrong move. This is where you may find a typical retail pattern like a bull flag, a bullish pennant, or a triangle start to form. And in this case, we got a symmetrical triangle. In TTC, we don't trade retail patterns. However, we will sometimes mark them out to see if they align with the model we trade or to see what retail might be seeing. For those that do trade them, coming from an uptrend, you would have expected this symmetrical triangle to play out to the upside. However, at level 3, this is a trap. So the market maker will show up during the symmetrical triangle to make you believe that it is going to break out to the upside and induce you to opening a new long position. But we know that this is just the second side of the M formation forming. No matter which time frame you've identified the first peak of the M, you'll generally drop down a time frame, and on the inside right side of the M, you should be able to see the market maker show up 3 times. So here I've identified the first peak of the M on the 1 hour time frame. If I drop down to the 15-minute time frame, I should be able to see the market maker show up 3 times on the inside right side of the M. And here on the 15-minute time frame, I can see the market maker showing up 3 times. This is the market maker showing up to trap traders long one last time. Once that is done, you'll be able to see how the market maker repeats the level of the first side of the M but falls short. They do that on purpose because they've trapped long traders in the initial peak of the M, and if they come back to that, then those traders have the chance to get out at break even. And if those traders that are trapped long close their positions, then that takes away the market maker's liquidity. Once you see the market maker show up 3 times, you should start to see wicks turn to the upside or bearish candles start to form. Here we have a bearish railroad track, and then again over here we have a bearish engulfing. Those wicks or bearish candles now give you the second side of the M and lets you know that market maker is ready to reverse price. If you find a multi-session or multi-day M or W on a 1 hour chart after your 3 level rises or drops, then you will more than likely have a weekly reversal. This is almost guaranteed to give you a 3 level drop. This allows you to set a fairly tight stop loss with an amazing risk to reward. If you need an exchange to trade on, consider checking out Bitchinix. With Bitchinix, it is a no KYC and also no VPN required, so you should be able to get access to this one worldwide. They offer welcome bonuses, and there's also a tab up here to win Bitcoin as well. Who doesn't love free crypto? Using the link down in the description below, you'll get a 25% trading fee rebate and also free access to our Discord. Now that we've broken down the M formation and all the key elements you need to look for, let's talk through those same principles for the W formation. I want to show you a W trade I actually took that played out perfectly. This is a great example of how everything we've just talked about comes together in real time. If you remember in the model we trade video, we talked about the weekend trap, the W or M formation that forms after the weekend trap, in this case AW, the 3 levels of rises or 3-day swing into the midweek reversal. Now this W formation still meets all the criteria for a perfect W, but what makes it even better is the timing of it and how it lines up with false move week beginning. Alright, so let's have a closer look at this W formation. So I'm on the 15-minute time frame, and here you can see we're in a solid downtrend and we've come from 3 levels of drops. What we're waiting for now is for the market maker to slam on the brakes to slow this momentum to the downside. So what are we looking for? You guessed it, a stopping volume candle. Little body, large wick, large volume. As you can see here in the PVSRA indicator down the bottom, the volume in this candle alone is really high compared to the previous candles that created the drop levels. Super high volume in that one little candle. That is the market maker slamming on the brakes to slow that momentum to the downside. So now we want to go through and mark out that stopping volume candle just so we know the area of interest to pay attention to when the market maker tries to repeat the level. Remember what I mentioned earlier about there being some sort of retail pattern forming at level 3 and that it may not play out? If we look left, we can see that some retail traders may have seen this as a recent support level that has now broken and retested as resistance. So they're likely getting ready to go short, thinking the market is going lower. But as we know, this is exactly where the market maker is setting the trap. This is the classic move to get retail traders to pile into short positions before the market maker gets ready to reverse price. So from here, now that we have our stopping volume candle and price has pulled away, what we're looking for is the market maker to show up 3 times on the inside right side of the W formation. Because I'm on the 15-minute time frame, we would then drop down to the 5-minute time frame. Perfect. Now we can see the market maker clearly show up 3 times on that inside right side of the W formation on the smaller time frame. We can then see price attempt to repeat the first peak of the W formation but fall short, trapping anyone who entered short based on the break of that support level in this move here. And at the same time, it traps anyone who tried to short the initial peak who thought price was going to drop lower. Now back to the 15-minute time frame. Now that we've identified our 3 level drops, our stopping volume candle, little body, large wick, high volume, and the market makers show up 3 times on the inside right side of the W formation on a smaller time frame, we're getting closer to our perfect entry. At this point, we're looking for our bullish confirmation candle to complete the W formation and signal our entry. And here on the 15-minute time frame, we can clearly see that we got the perfect bullish hammer to then complete our W formation. Once you get your bullish candle on the second side of the W formation, that is your entry signal. Your stop loss then goes below the first peak of the W. In this case, not only did we get a hammer, but we also got a morning star. So for me, I didn't take the entry off the bullish hammer there. I took it off the morning star, which gave me even more confidence in taking an entry. If you were dealing with an M formation, same thing. So once you get the second side of the M formation and your bearish candlestick pattern, that is then your entry, and your stop loss goes above the first peak of the M formation. From there, you can hold your position for 3 levels or 3 days. For this particular trade, I decided to hold for the weekly setup, which is the 1 hour time frame, and aim for 3 levels of rises. Once I'd counted my 3 levels of rises and identified what I seen as the stopping volume candle, I moved my stop loss up under previous market structure to protect my trade. And as we can see on the chart, price eventually wicked down, hit my adjusted stop loss and closed my trade out, closing my trade out at a 5.5 to 1 risk to reward. So remember, it's not just about identifying any M or W, it's about identifying them in the right place in the model. If you want to learn how to trade like this in detail, consider joining TTC by using the link below.